Hello and welcome back to another episode of the Investor Financing Podcast. We have a special show today. We're going to do a Q&A. We get these same questions over and over again, so we formatted them. And Bill, who handles a lot of my marketing, is going to ask some questions that we've been asked over time, over and over again. We figured that this would be a good show to do monthly at least, where we take some of the common questions we're getting asked and answer those questions on the show. So thanks, Bill, for joining us, and let's get started.
All right. Okay. So this is one of the most asked questions we get pretty much on a daily basis. And that is, what is a DSCR loan and what are the qualifications for getting one?
Sure. Good question. So DSCR stands for debt service coverage ratio. So basically, when you're out there, if you were to buy a property and go and get a conventional loan, they're going to look at your income and they're going to qualify you from an income basis. Debt service coverage ratio loans, we don't require any income documentations. The loan is based off the loan to value and the cash flow of the property. So basically, no tax returns, no W-2s needed. It's what's the purchase price, how much rent are you going to collect or are collecting, what are your annual taxes, what are your annual insurance, do you have an HOA? Then we calculate the debt service coverage ratio, which we're looking typically for a 1.1 or greater. The greater the debt service coverage ratio, the better returns you're getting, essentially, from a cash flow perspective.
Cool. Another question we get a lot is, what are the main differences between, conventional or traditional financing and DSCR loans?
So going back to conventional, on conventional, they're going to look at your income and they're going to look at all of your liabilities, your expenses, and you have a front end debt ratio and a back end debt to income ratio. And basically, if your debt ratio is too high, typically over 48% with all your payments, your back end debt ratio is over 48%, you're not going to qualify to get another loan. Additionally, on any rental properties that you have, they'll only take 75% of gross rent. So even if you're collecting $2,000, they're going to only use 75% of that $2,000 for underwriting. So usually after the first couple of properties, you're not going to qualify from an income standpoint. Hence, that's why we came out with debt service coverage ratio loans, where we don't need W-2s, we don't need income. We just look at the income that's going to be generated from the rental and your expenses, your debt payment, and your taxes, insurance, and HOA if you have one. And so as long as the income is greater than the expenses by about 20%, then that means it's a good deal for a debt service coverage ratio loan. Now, if it doesn't qualify, we can go as low as 0.8. So even if it's not there's some lenders that will go under 1%, but typically I tell people you need a 1-2 debt coverage ratio to get the best rates.
All right, great. Now I know for some of these loans, many lenders only use long-term projections. Can we use projections for short-term rental properties like Airbnb?
Okay, great. So let's just say you're buying a property and it's gonna be a rental. Most of the debt service coverage ratio lenders are gonna say, okay, we can do this loan. We're gonna do an appraisal, and attached to the appraisal, we're gonna do an addendum called the rental survey. And whatever the appraiser deems that the market rent would be for a long-term rental, they're gonna use that to qualify you from a debt service coverage ratio standpoint. Now, a lot of properties that we're buying that are going to be short-term rentals will never qualify from a long-term rental standpoint, from a debt coverage standpoint. So that's why there's a handful of lenders that we work with that will actually use something similar to AirDNA. And AirDNA is kind of like the Zillow of what your property on a short-term rental standpoint will cash flow. So it can analyze your address and say, okay, it's a 4-bedroom, 2-bath, 2,000 square foot home. Your average occupancy level is going to be 70%. Your ADR, your average daily rate, is going to be $200 a month, and this will gross, estimated at X amount of dollars. And so there's companies that will actually use this formula and underwrite the income from that number. That's a projection-based DSCR loan. So there's a lot of ways. Whenever I have a client or a prospect that's talking to me about getting a DSCR loan or a rental loan, I always say, listen, let me know what the long-term rent would be. Let me know what you think the gross annual short-term rental income will be. And then if it does qualify from a long-term rental standpoint, it opens up the door to more lenders. And that's the whole key, because usually the long-term rental loans are better priced than the short-term rental projection-based lenders. So I want to be able to offer you the best of all the worlds. And so that's why I'm asking these questions to see what the best loan would be. Hi, this is Beau, host of the Investor Financing Podcast. Are you a real estate investor with properties and you're trying to figure out how to refinance or grow your existing real estate business? Need some clarity and a game plan for moving forward? I'm offering a free strategy call where we dive deep on your real estate investing goals. I'll help you come up with a strategic finance plan that will help you get to where you want to go. Whether you've got a portfolio of 30 properties or you're starting out with your first property, I have a framework that has helped many investors grow. If you're interested, book a call below in the Calendly link.
Now, why would we want to use a bridge loan for financing as opposed to a DSCR loan?
Okay, so the good question. So we get this asked a lot here. Sometimes you're buying a property and it doesn't have a tenant. It won't qualify from a long-term rental standpoint. And if you went into a projection-based DSCR loan, the rate is maybe a little bit higher right now because obviously rates are up. And if you can show 12 months of history from Vrbo or Airbnb, we can use that 12 months later. So a bridge loan. So oftentimes I'm telling my clients, let's go into a bridge loan now for 2 years. It's an interest-only payment. Rate's a little bit higher than a DSCR loan, but there's no prepayment penalty. Usually these DSCR business purpose type of loans have either a 3 or 5 year prepayment penalty on them. So you're kind of trapped in there or you're going to pay the penalty. Whereas if we go in and use this bridge loan, we can get in and season the property and use the rental income after 12 months. And we can also put that rental income on your tax returns. And so you'll have options. You can potentially qualify for a conventional loan on a refinance, or potentially you just go into a DSCR loan. It gives you options because I do think rates will come back down in the next 18 to 24 months. And then you're not locked into a 5 or 3 year prepayment penalty.
Okay, so kind of adding on to that, why do DSCR loans typically have prepayment penalties?
So prepayment penalties on these investor loans, because the investors want to make a certain return. So if you pay off early, they're calculating that they'll get the return. That's why they put either a 3 or 5 year prepayment penalty. Most of the projection-based DSCR loans have a 5 year prepayment penalty, whereas some of my standard long-term rental DSCR loans only have a 3 year prepay. So that's why I'm always trying to qualify you from a long-term standpoint, even if it's going to be a short-term rental. Doesn't matter, but just for qualification purposes, we're doing that. Going back to the bridge loan, the other reason you might want to use a bridge loan is because if the property needs work, you can finance some of the work with a bridge loan. So I can lend up to 90% of the purchase price and I can hold back 100% of the repair costs. So you can make improvements, fix up the property, run it as an Airbnb, get 12 months of history, and I can lend you up to 90% of the purchase, 100% of repair costs. So you're actually getting higher leverage. So you're putting less money down and you're creating value. Now, the bridge loans usually are capped at 75%. So whatever the ARV is, or after renovated value, I can only do 75% of that. That's my gross loan amount. So it's a pretty simple formula. So usually what I do is, and you guys can all do this too, is book a call below and have a consultation. We can walk you through like the different options. And that's what I do all day and figure out what makes sense for you on this particular project. Maybe you have some rental properties. Maybe we could pull some equity out of there. Basically, that's what we do. We help investors grow their portfolios through strategic financing. And this is a common call. Like, this is what a call looks like for me every day. People are asking similar questions. And that's why we wanted to address them on this Q&A session.
Cool. So you'd said earlier that rates are up, and I think we all know that. What are some strategies to use right now?
So strategies to use right now is call somebody that's knowledgeable, like myself, in the lending space, or somebody like me that has been doing this for 20 years, whether it's me or anybody else, and get them to give you some quotes and let them know what you're looking to do. And that's oftentimes when I bring up the bridge loan, like, hey, what's the play here? What are you trying to do? Are you trying to leverage? Maybe a bridge loan's better because we can put less down and we can keep more in reserves in our pocket. And so we can buy another property as opposed to putting more down on this property. Maybe I can buy 2 properties. And then knowing like your plan, like maybe you want to reposition in 2 years. Well, maybe putting you in a 30-year DSCR loan isn't the best move. Maybe I can put you in a 5-year fixed with interest only payments so you increase your cash flow. So really, that's what I'm looking at is like your overall goal. If your goal is like, I want to just buy it and forget about it and 30-year fixed, then that's fine. But maybe your goal is to increase cash flow. So going into an interest only loan makes more sense. Maybe your goal is that you're buying it at a discount and you know in 12 months time it's going to appraise at $100,000 higher, and then you can BRRRR the property, right? So a lot of times we talk about BRRRR, buy, renovate, refinance, repeat kind of thing. So if we're talking about that, what we want to do is use a bridge loan to get in, fix up the property, run it as an Airbnb for 12 months or less. We can typically use new appraised value after 4 months with most lenders. So if you buy it for 200 and put in 50 and then appraise it at 400 a couple months later because you bought it cheap and you did value add, at the 4-month mark, I can use that 250 and I can lend 70 to 75% of that 250, get all your money back out, recycle your money. So that's really what we talk about strategy. So the strategy right now that I'm pushing a little bit more than I was before is to go into a 2-year bridge loan with the thought process that rates will come down. And you can get a little bit higher leverage than you could on maybe a DSCR loan.
Great. That was our last question for today's batch.
Okay, cool. So we have set up for you, if you go to investorfinancingpodcast.com/ask, there's a little questionnaire. If you have any questions that you want to ask, we're going to do these on the Q&A. Go to that website, investorfinancingpodcast.com/ask, and fill out your name, an email, and your question, and we will answer your questions. And it can be regarding SBA, it could be regarding fix and flip, short-term rentals, commercial loans, anything investor lending or business lending, unsecured lines of credit. We'll answer those questions, or we'll get an expert to help answer any questions that I can't answer.
Cool.
Well, thank you. And thanks, Bill, for joining us on this episode. And hope you enjoyed this Q&A session, and we'll see you on the next episode.